Hello everybody and welcome back to another special weekend edition of our daily show where we talk about stocks, commodities and cryptos. A few weeks ahead we mentioned the relationship between the Nasdaq and the SP 500, a chart that's held for 20 plus years. With the trend line still holding, it means something is happening underneath the hood of the stock market that we need to look at today in the video. A lot of rotation is currently occurring. But what does this mean for your portfolio? Well, basically recession fears have mounted. We're now upwards in some metrics to 76% chance of a recession. Most of you probably already believe it's coming. Fair enough too. And on top of that, we also have smart money continuing to buy even in this current downturn. What does that mean for the next couple of sessions into the next few weeks? Will we see another dead cat bounce or are we going all the way to the 200 SMA? Stay tuned as we uncover what's happening in this market right now together. See you soon, guys. This will be a good one. Well, welcome back everybody to our show here, and we'll start by talking about recession fears because of course now everyone is talking about it. It's become the most searched time ever on Google Trends for recession. Recession fears spike among CEOs with 60% forecasting an economic downturn. Bloomberg also has reported 76% chance of the US now entering a recession. So it's big news out there in terms of what's going on in these markets. GDP forecasts have also been changed and downgraded here. Bank of America just coming out with a 1.5% quarter growth, down from 2.5%, and Goldman has also lowered its growth target 2.8 versus 3, with the Atlanta Fed going so far as to say 0%. Before we get into anything else, I just want to mention that today's video is sponsored by Tiger Brokers, and we've got a little bit more about the special offer they have for you guys in the community later on today's video. Let's talk about sentiment votes. So basically the sentiment from the bullish surveys or bearish surveys, if you want to see them out there in investors, has shown 58.3%. Now this survey was taken just before the rate hike. So you'd probably expect it's probably even worse now in terms of bearish sentiment from retail traders. We do sometimes look at this report and think of it as counterintuitive. If everyone's bearish, then it might be good to be bullish, but only if you get the right signs. That's a trader's instinct. An investor's instinct, obviously, you've got to look at it from a way larger time perspective. 19.4% are bullish, 22.2% are neutral. So a huge bearish reading here from the retail community. Let's now talk about what happened on the Friday session though, because this becomes important when we think about the long weekend that we've got now in the US. Of course, Monday not open. The stream will be on Tuesday, the one we do here live on the channel. Subscribe if you're interested in that. And we will basically be going through everything for the week. But this session was mostly just holding firm. And what that meant was it was quadruple witching. Effectively 4 different options were all expiring at the same time. Huge volume, huge fear. The market held as best it could. Notice though that the Nasdaq and IWM were the 2 best performers for the session. A little bit of risk on there across that board. So do we have any positive news coming out for the markets? Well, one of the positive news is the supply chain crisis is easing rapidly. A lot of this is most likely due to, of course, the lack of demand coming through, which is going to affect, of course, things potentially like the GDP in the future. But you'll notice here that the actual supply chain crisis has started to decline, which is good news for everybody really out there. But of course, the cost to that is not so good. Demand, most likely the dropping side. We mentioned smart money is still buying, and the smart money flow index has actually completely diverged with price. This is unusual. You don't usually see these types of huge drop-offs without price coming with it in some way. So interesting that a lot of people have started picking up this level. I would say the reason why they're picking up this level so much is because of the 20% decline. Everyone talks about bear market territory. The 20% level, now we're slightly lower than that in S&P 500, has excited many smart money investors, and they're picking it up, probably looking at a longer term horizon than many. But interesting, this divergence. We'll continue to watch this through the next few weeks. S&P 500, huge declines in terms of 9% plus over 4 days. We keep bringing this chart up. The reason I bring it up, because if we see a technical turnaround, which we'll talk about soon, doesn't mean a large technical turnaround, just a smaller one. There could be a bit of a dead cat bounce here. There's many reasons to say that we're hitting or going towards a 3,500 or even 3,200. I've talked about how I've spoken with a few billionaire bond managers, most of those guys kind of point towards 3,500 and 3,200 levels at some point, maybe even 2022 or the start of 2023. But for now, we're talking about the here and now, and that is that 4-day declines tend to be led, as you can see there on that stat, by some form of turnaround after. And that could be just like a dead cat bounce or something a little bit better. Let's move over to the VIX. VIX did drop through the Friday session. We hit the 35, which is that peak fear that we've seen most of 2022. And that's often coincided with a bit of a base formation that starts structuring up, that creates a small rally that then can get dumped off. So we'll talk about that soon. US 2-year did actually rise fairly substantially. We got back to 3.18. We saw that turn around though. So this was a huge spike in the 2-year due to, of course, inflation and everything else. Then we've seen it come back down, break underneath all of this, and then rally back. That's consistent with what we would have expected and what we spoke about in the previous video. The US 10-year is similar, still holding underneath, just coiling at this point. And of course, if the market is to go bullish, we would like to see the 2-year and the 10-year continue to decline. That would kind of give you the tick of approval that that move is more real. So watching yields is super important in 2022. Speaking of yields as well, the 2-year going back up versus the 10-year kind of holding has almost caused another inversion here of the US 2-year versus 10-year. These inversions do matter. And as we see more inversions happen, the chance of recession becomes basically more and more likely. Remember, if ever there's been 50% yield inversions across the board, it has 100% of the time always meant the US is going into a recession. So when that happens, even if we don't have the GDP number, it's 100% of the time that's occurred so far. Let's talk about the dollar index. So the dollar index actually wicked all the way back down, a huge down closure in the last couple of days of trade. So let's have a look here at actually the session. The daily came up. It hit our role reversal area, that is the previous support becoming resistance, went through it a little bit and then sold off to close right on that level. And this is going to be pretty critical when we look at things like the 1-hour time frame, because of course, if money is coming out of the US dollar, that will be a positive potentially for risk on assets as well. You want to time them together as much as possible. Here's the huge level. Here's what many would call a Wyckoff distribution. So we obviously have the UTAD here, or the UT, which is that false break to the upside. We've now closed below. We've come back up to grab the liquidity, to grab all the orders. And at this stage, the week ahead, the levels that I think are most important are actually going to be around this demand area here. Notice the dojis, notice the wicks. This level is going to be a big one to fight with in terms of the smaller time frame. So scalpers and day traders will look close at this 104.20. If we breach underneath, expect a small pull up to a zone that we'll be talking about, I'm sure, in another subsequent video. And at that point, we're really just looking more towards downside positions. And of course, currencies, when the VIX is so high, become a very good area for traders to go into to eliminate some of the risks they have by being a stock picker. Remember, when VIX is above 25, bring in your instruments. If you ever wonder why you get owned on certain stocks, such as penny stocks, etc., they don't care about your technicals at these fearful times. It's all about bringing it in to these. Let's move over to gold now and have a quick chat about gold. So as you'll notice here with gold, we have a pretty big turnaround in terms of what's occurred in the last subsequent weeks. Notice the wick coming off the demand zone, the long leg doji, the wick again. So gold is holding up pretty well here in the markets. Let's go down to the daily now and have a look at the previous sessions. Again, the big demand zone here, this 1810 will be pivotal for the next week. A break above 1880 would be huge for gold. And if we are in a point of stagflation, which many people believe, where effectively we're going to have to raise rates, but of course the economy's in stagflation, gold does tend to do quite well off that. Long leg doji off the 2-hour here in the session. Previous little bit of support, resistance. This zone here, hopefully buyers come back in. And what you're looking for as a gold trader right now is a new high taking out this level. And that should then signify strength into what you would think is our red box up here. So day traders will be looking at this level fairly closely. And of course, that's the 1852. We'll move over to US oil. US oil dropped, another day of very bad declines for US oil, 6% down. This is a fairly big deal. We've talked about the weakness here on oil. Let me just show everybody how we got to that idea. Of course, we saw these levels here. We saw the movement from oil to go to basically BC. We had the UT, had of course Wyckoff distribution. We breached underneath our heavy demand area right here, rallied, and since that point we've had a negative bias on oil. A few people asked us in the private community if you're ever interested in joining that or our public Discord, links in the description down below. And when that level broke in the previous session, what a great scalp trade. So oil was probably the best scalp trade, in my opinion, for the Friday session. That was a huge trade and it just fell off a cliff as algorithms smashed through the levels of oil. If we go back to the daily here on US oil as well, you'll notice that it has taken out one of the daily levels, changing trend for that as well. So you can see here, higher, higher low, higher high, breach. There might be pullbacks, but at this stage, oil is in a negative trend on these markets. So I'd just like to give a quick shout out to Tiger Brokers who are sponsoring today's video. If you're interested in some of the special offers that they have for the FX Evolution community, check out the links down below. There's some extra shares that you can get if you open an account. And of course, you do get access also to their platform. And their platform has one of these cool features. You guys would know that I love looking at different sectors within the market. I think this is the biggest thing that people often underestimate. You can also switch around in this and just do percentage daily and stuff like that so that you can see some of the things that have actually got the biggest bullish moves on them for the session. And of course, if you can target the area where the algorithms, the composite man, whatever you want to call it, is really targeting for that session, it can be very helpful in real time. So let's move over to what we mentioned at the start of today's video, which is of course Nasdaq versus SPY. Check out this trend line. What a beast. It's been going for 20 years. Let's go down to the 2-hour time frame now to understand the ratio and how this is currently forming. Take a look at this. Does it look familiar? It should, because it looks like at this stage some form of accumulation between the ratio. Effectively, it's basing. And what this is showing you in relative performance, it looks to be that the Nasdaq should outperform the SPY now when we're about to get market recovery. So if there is a dead cat bounce in the market over the next week, 2 weeks, month, or whatever, and we see a breach out of this level, would that be good information for us to have? Absolutely. And it's something we've suspected for a while, but check out this. We've got, some people would call it inverse head and shoulders. Some people would call it a Wyckoff accumulation. It's all sorts of things, but it's certainly coming back up here and it's holding the trend line as best it can at this stage. A certainly very interesting under the hood look at risk on versus risk off. Speaking of risk on versus risk off, we use consumer discretionary versus staples here. Another decent session for this, 1.46% in terms of the increase. And as you'll see, we're still nowhere near the new lows, which has shown that the rotation of relative performance has been coming in here for the riskier kind of stocks as they're bottomed to some levels. We might have a special video coming soon as well where we compare Amazon, ARK, and all these other stocks with their comparative lows to where, of course, the SP 500 is right now. I think you'll be very interested to have a look at that video. Another one is Dow Transportation's average. A lot of people look at this as turnaround signal. Of course, in March of 2020, it turned around, and we saw also the turnaround in December here. There is no turnaround at this stage for the transportation average. So it's just continued another week down. We go to the daily. There's no signs of this relentless selling currently really turning at this stage on the higher time frame. So remember, investors and day traders have different kind of parameters to what they're looking for. If you're looking at investment side of things, it's difficult to say that there is a case to be said that we're not going lower at this point on a lot of these technicals. Let's move over to Tesla. Tesla is in the traders demand zone, which is of course this box area that we've talked about at some length. The weekly still holding above that. Underneath that level opens the 550. Daily held okay for Tesla, not too well really. And we saw the move around in the 1 hour off the demand zone. This is such an important area. If this can't hold, Tesla traders beware, because the next level, it looks to be 550, and of course the market would be making a new low at the same point. What is good news though could be the turnaround if you were to see it, which would be something like this, boom, boom, breach. Look at that 700 level. What a huge level of supply, previous demand. This zone here, if we breach, it's going to be a fairly big deal, you would think. And the market will also be doing something very special, which we'll look at very soon. So turnaround could be coming at this stage. We're in the middle of that zone and it's kind of at a small point of resistance. So demand is down here, resistance is up here, and day traders will be looking for new spike highs of this level to try to clean up the gap that's been left on this market. So that's really the trade that I think most people are looking for the week ahead. A small relief rally to hopefully fill that gap, and similar on Apple and others. Let's look at the Russell 2000, new low that was formed this week on that. Plenty of gaps left behind. I can't remember the last time I've seen so many gaps on indices in terms of just down gaps other than 2020, which was kind of a different period and certainly a very aggressive market. Has it turned? Not really. Key levels for the week ahead, we're looking at something like this zone up here, which would be the big turnaround. At that point, you'd be turning so many timeframes. You'd basically first direction timeframe trending on the 1 hour, the 2 hour, the 4 hour, all of those. And I think if we do breach these types of levels here, which sit around that 174, we move to fill both gaps would be the most likely scenario. Is it a dead cat bounce? Well, we'll talk about it at that point if it does occur. For now, though, the trend is very tough to pick here on the Russell 2000. Let's take a look at Nasdaq. Nasdaq weekly is still outside of the Bollinger, guys. This is basically an extreme low, of course. We end the week with a, I guess you would say, doji style candle. Could it be some form of equilibrium? Yeah, I guess it could, but realistically, it's kind of around that level of previous demand that we've seen. There's also a moving average that's here, and we'll bring it up and I'll just add it to the chart now so you can all see it together. And when you're adding something like a moving average here, this is the big one that every single huge investor looks at. They look at the 200 moving average. This area has been a precision house of the last decade, I guess you would say, at picking lows. Now, more so on the SP 500 than the Nasdaq. The Nasdaq never showed weakness like it is right now, but you'll notice that it got within a little bit close of it in previous sessions. When you see the S&P 500 one in a moment, you'll be like, wow, it's so much better. But check out this, it's getting closer. There's a lot of previous buying that occurred through this zone for the Nasdaq. And I think that's why relatively, with the Nasdaq down as much as it is, let's have a look at how much it is actually down here right now, 34%. It does have that ability to potentially base here with some of the big stocks finding some big levels, Amazon, Microsoft, Google, etc. Let's take a look at S&P 500. A lot of people are sending me this chart and they're saying, Tom, the trend line has broken down. Do you think that means capitulation? Well, this is where the 200 SMA comes back in. 3,500 previous resistances. If you draw that line across, what a level, yeah? A lot of people will be watching this. And the reason why is when you zoom out. If you take a look at these charts, look at this. The 200 SMA, the 200 SMA. I mean, the 200 SMA, 200 SMA resistance, support. It's a big deal. Look at how it hugs it and it loves the 200 for so long, for basically 20 years. So this is a big level. And this is where a lot of people suspect funds might be coming back in if we continue to go down. Remember, the trend still hasn't changed to the upside for someone like an investor or a swing-based type trader. It's down, 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 down at this stage. That's all there is. Let's go under the hood, take a look at the daily together. Well, the daily is a little bit better, I guess you would say. It's got two gaps that are sitting through these areas here, which of course could be moved through. There's also a third gap that's sitting in this area. We've talked about that. Long leg doji, so with equal lows. Now that's the important thing, equal lows. Take a look at the volume. Whoa, they don't call it quadruple witching for no reason. Take a look at that. Remind you of something? Similar time? Yeah. So quadruple witching has occurred. It does allow potentially now all of the shenanigans going on with the options market to come out. And let's have a look now at these smaller time frames. 2 hour, tons of wicks. Is there demand buying going on here? It certainly could be. Where will bears come back in very heavily though? If we breach past those equal lows, that is the level of, let me just have a look here, around 36, you would think at that point the market's basically signaling maybe they want to capitulate it to the 200 SMA, the 3500 is the next area. But if through the week we actually end up closing up and we start to move through, let's look at the 15-minute now on the S&P 500. Notice it's forming some form of accumulation base. We breach through some of these key levels, and then all of a sudden we could rally to fill some of these gaps. So let's look at the US 500 futures to have a bit of a better idea of some of the key zones. So you'll notice here, there's two big levels. There's the resistance or the supply that's here, and the other little sneaky one that's sitting here. So I'll put two horizontals through them so you guys can see the key levels. You've got one at 37.27, and then you've got another one which is formed through the Friday and pre-Friday sessions, which is here. For bulls, what they need to see is the change of trend. Where's it going to start to happen? The breach of 37.08 on the smaller time frames. We made a new low, as you can see here through the session. That is a new low. Technically, we would first time frame trend change here. We've got to be careful of that supply. But if you get through this zone, what's next? 37.80. Why? 37.80 would be where the gap fill would be for the S&P 500. So there's a little bit to like here for both the bulls and the bears. The bears will be salivating over this level. They'll be looking for false breaks that look like this in the week ahead that would come off that level of supply, which we already know sits there, and the orders are sitting behind it to a degree. And they'll be looking at then taking shorts through at that point down. If we just end up tanking through this level, shorters will come in, potential capitulation, monster fear could come into these markets. But I would say that it looks to be that it could be going a little bit bullish here. If we rally through, we get through that zone, especially this zone, the gap fills, we get above here, then we fill the next two gaps. So there's some super levels here. Very interesting technical trading. Hopefully that stuff helps, and give the video a like as well if you do find these things semi-helpful. Let's move over now to the max pain. Of course, it didn't work at all last week. No surprises there with all of the massive manipulation that was going on in the markets. And we move towards the 24th now as our next technical max pain, 384, so completely different level. You'll see some calls that are stuck up here at the high 400s. No real put walls. I mean, funnily enough, where is the put wall that a lot of people are looking at? Just underneath 350. What level's that? Of course, the 200. So 345 seems to be a decent level in puts, and it's a few puts that have been entered through all of this area down here. So again, it could point towards maybe a slightly higher market for the week ahead. If we move over to Bitcoin as well, this market is in all sorts of trouble. It continuously pressures the 20,000. Take a look. I mean, this thing could go through just on this weekend. It's pretty horrendous. Lower highs. No system would be saying, oh, I love this level right now. But of course, breach out, you get through these areas, all of a sudden, then you've kind of gone from making a series of lower highs to a higher high, and rallies could come back in this market, but it is putting huge pressure, downward pressure that is, on that 20,000. And if it gets through, be warned, Bitcoin can really chunk due to low liquidity on weekends, so it could get through, a couple of $1,000 before finding any buying pressure. If we look over to the weekly, that would put us down to around that 18, 17 and a bit thousand. So yeah, not really too many good signs yet for Bitcoin. It's still very, very sketchy out there. And really, when you're trading crypto during this type of market condition, it's all about Bitcoin and nothing else. We'll move over now to the news for the week ahead. We've of course got the bank holiday in the US for the Monday. We've got some other central banks around the world bringing out some information, some decent data coming in from a few others. And then we've got our good friend Papa Powell coming out. Fed Chair Powell testifies Wednesday, 9:30 a.m. New York time. Then Fed Chair Powell testifies again, 10 a.m. Thursday, New York time. Fantastic. I'm sure you guys are looking forward to whatever he has to say about all the tools and how we're not in a recession and whatever else he has to say. We're not seeing the signs, he says, even though there are signs everywhere in the market. So yes, it's going to be another big week of trading. It will be left to its own devices. So that means the technical trading might come back in and less crazy options trading and quad witching and all of these types of things. If you enjoyed today's video, please remember to subscribe, smash that like button, guys. And of course, a big shout out to Tiger Brokers again for their sponsorship of today's video. You can check out their links down below. Thanks very much. Catch you later. Have a good weekend.